Ever wonder why some projects look great on paper but fail to create real value? Let's find out what the board truly cares.
Many finance teams rely on IRR because it's easy to present, a simple percentage that looks impressive. But when your proposal reaches the board table, that single percentage often fails to convince. Boards ask, how much value are we actually creating? That's where NPV comes in, the metric that turns financial theory into tangible wealth.
Let's uncover the secret behind NPV, the number that truly builds value.
Boards operate under one core principle: value creation. IRR measures efficiency, how fast money grows, but NPV measures how much wealth that growth actually adds. Imagine two projects. Project A investment 1 MUSD IRR 30% NPV plus 50K USD. Project B investment 5 MUSD IRR 22% NPV plus 600K USD. If you choose based on IRR, you'd pick Project A. But the board will prefer Project B because it adds 12 times more value to the company. So, don't chase the higher percentage, chase the higher value.
Here's the secret formula behind real value creation.
NPV discounts all expected future cash flows back to today's value. It tells us, if we invest now, how much richer will the company be after accounting for the cost of capital? Imagine a project with initial cost equals $1 million inflows equals $400,000 per year for 4 years. Cost of capital equals 10%. Graph shows cash flow bars declining in height by discount rate, overlay present value dots connected by line. Compute step by step. PV equals 400K slash 1.1 plus 400K slash 1.1 superscript 2 plus 400K slash 1.1 superscript 3 plus 400K slash 1.1 equals $1.27 million. NPV equals 1.27 M, 1 M equals plus $270K. That $270,000 is real wealth added. Every time you see a positive NPV, that's new value the board can touch. It's profit beyond capital cost.
IRR looks shiny, but not all that glitters is gold.
IRR is the rate that makes NPV equals 0, the break-even return. If IRR, cost of capital, the project seems profitable. But IRR hides critical assumptions. All intermediate cash flows are reinvested at the same IRR, rarely true. It ignores project scale. Multiple sign changes in cash flow can produce multiple IRRs, creating confusion. Graph shows NPV versus discount rate curve intersecting the x-axis several times. Label multiple IRRs equals multiple truths. So, while IRR helps show efficiency, NPV tells the truth about total impact.
What happens when NPV and IRR don't agree? Let's visualize it.
Let's test two real-style projects. Discount rate equals 10%. NPVA equals plus 19, A equals 24%, NPVB equals plus 25, B equals 20%. Graph explains animated bars showing each project's NPV and IRR. Highlight board decision arrow pointing to Project B. Project A gives faster return, but Project B adds more total value. Boards choose value, not velocity. That's why finance leaders say, trust NPV when the numbers disagree.
Here's how to make your CAPEX presentation board-proof.
A convincing CAPEX pack shows 6 pillars. 1 NPV, base case value in dollar terms. 2 IRR, efficiency versus WCC. 3 payback period, time to recover. For sensitivity analysis, how NPV moves with cost or delay. 5 scenario analysis, best/base/worst cases. 6 strategic fit, how it supports corporate goals. Dashboard slide cycle through panels. Sensitivity tornado chart highlights NPV swing, minus 20% to plus 15%. When you visualize both value and risk, your board discussion shifts from why approve this to when do we start?
Let's fix the most common mistakes that make projects look better than they are.
1. Wrong discount rate. A 1% error can swing NPV by 10 to 15%. 2. Ignoring capital limits. Positive NPV doesn't mean unlimited funding. Rank by NPV per CAPEX. 3. Relying on plain IRR, switch to MIRR for reinvestment realism. 4. Skipping strategic value, include qualitative returns, market entry, synergy, tech edge. Bar chart comparing base NPV versus MER-adjusted NPV. Difference visualized in cyan versus orange bars. Numbers must meet narrative. That's how you earn board confidence.
Now you know the difference, but the best leaders know how to use both.
Lead with NPV. Show absolute value. Use IRR for confirmation only. Include sensitivity and scenario charts. Normalize results by NPV per $1 million CAPEX. Keep worst-case NPV positive. Reveal assumptions transparently. Add real option valuation for strategic projects. Automated dashboard, before versus after board-proof formatting. Professionalism isn't about flashy slides. It's about financial clarity that earns trust.
NPV shows value, IRR shows speed. Together, they build your board confidence.
In the end, percentages don't persuade, value does. NPV is your North Star for wealth creation. IRR keeps you efficient. Use both, but let NPV lead. That's how great financial leaders earn board approval and strategic respect. If you found this helpful, subscribe and join me, Thanya, every week. Together, we'll turn complex finance into confident leadership.
Subscribe for more finance insights and make your next investment board proof.